Look, I need you to pay very close attention to what I'm about to show you because what just happened in the silver market hasn't occurred in over 4 decades. And the implications of this move are so profound that if you don't understand what's happening right now, you could miss the biggest wealth transfer opportunity of your lifetime. Silver just broke through a price level that it hasn't sustained since 1980. Let me say that again. 1980, the year Reagan took office. The year the Hunt brothers tried to corner the silver market and sent prices to the moon before it all came crashing down. That was 45 years ago, and we're back there now. But here's what makes this different, and why this time the story doesn't end the same way. In 1980, the Hunt brothers were trying to artificially manipulate the market. They were buying up physical silver and silver futures contracts, trying to create a squeeze. It was a speculative play, driven by 2 billionaire brothers with deep pockets and a risky strategy. When the exchange changed the rules and raised margin requirements, their empire collapsed, and silver crashed from $50 an ounce back down to single digits within months. What's happening now is the complete opposite. This isn't speculation. This isn't manipulation. This is fundamental supply and demand economics playing out in real time, and the forces driving silver higher today are so powerful, so structural, that they can't be stopped by changing exchange rules or raising margin requirements. Let me walk you through exactly what's happening, because once you see the full picture, you'll understand why some of the smartest money managers in the world are calling this the trade of the decade. First, let's talk about supply. Silver production peaked in 2016. Since then, global mine supply has been declining. We're pulling less silver out of the ground every single year. Why? Because the easy deposits have been mined. The high-grade ore bodies are depleted. What's left requires going deeper, processing lower-grade ore, and spending more money to extract less silver. Mining companies are facing higher energy costs, stricter environmental regulations, and longer permitting timelines. It takes 7 to 10 years to bring a new silver mine online, even if you find a deposit worth developing. Meanwhile, above-ground inventories are vanishing. The COMEX warehouses in New York, where silver futures contracts are settled with physical delivery, have seen their registered silver stocks, the metal available for delivery, drop by over 60% in the last 3 years. We're talking about hundreds of millions of ounces that have simply disappeared from the exchange vaults. Where did it go? Into private hands, into industrial applications, into solar panels and electric vehicles and 5G infrastructure. Because here's the thing about silver that makes it completely different from gold is primarily a monetary metal. Central banks hold it. Investors buy it. Jewelry accounts for a big chunk of demand. But most gold that's ever been mined still exists in some form. It gets recycled. It sits in vaults. It doesn't get consumed. Silver gets consumed. Roughly half of all silver demand comes from industrial applications, and once it's used in electronics, in solar panels, in medical devices, in water purification systems, it's gone. The quantities are too small and too dispersed to economically recover. A solar panel might contain 1/3 of an ounce of silver. When that panel reaches end of life in 25 years, no one's going to spend the money to extract that silver. It's lost forever. And industrial demand is exploding. The solar industry alone is projected to consume over 200 million ounces of silver this year. That's nearly 20% of total global supply going into one sector. Electric vehicles use twice as much silver as traditional cars. Every EV contains about an ounce of silver in its electrical systems. Global EV sales are growing at 30% per year. 5G infrastructure, the build-out of next-generation wireless networks, requires significantly more silver than 4G. We're talking about millions of new cell towers and base stations, each one packed with silver-containing components. Then there's the investment demand side. Silver ETFs, exchange-traded funds that hold physical silver, have seen massive inflows over the past 18 months. The largest silver ETF, SLV, now holds over 500 million ounces. That's metal that's been pulled out of the market and locked away in vaults. It's not available for industrial use. It's not available to satisfy futures contract deliveries. It's just sitting there, owned by investors who are betting on higher prices. And those investors are reading the same data I'm showing you right now. They're seeing the supply deficit. They're seeing the inventory drawdowns. They're seeing the industrial demand growth. And they're doing the math. When you have declining supply, surging demand, and falling inventories, there's only one direction price can go. But wait, because it gets even more interesting. Remember I mentioned the COMEX, the futures exchange where silver contracts trade? Here's something most people don't understand about how that market works. The vast majority of silver futures contracts never result in physical delivery. Traders buy and sell paper contracts, speculating on price movements, and when the contract expires, they either roll it forward to the next month or settle in cash. Only a tiny fraction of contracts actually demand physical metal. This creates a situation where the paper market, the futures contracts, can trade at volumes that are multiples of actual physical supply. On any given day, the amount of silver trading on the COMEX can be equivalent to an entire year's worth of global mine production. It's a paper market that's disconnected from physical reality. But something's changing. More and more contract holders are standing for delivery. They're saying, I don't want to settle in cash, I want the actual metal. And when they do that, the exchange has to deliver physical silver from those registered warehouse stocks I mentioned earlier, the stocks that have already dropped by 60%. Do you see the problem? If this trend continues, if more traders start demanding physical delivery, the exchange could face a situation where there isn't enough registered silver to satisfy all the delivery requests. That's called a squeeze. And when a squeeze happens in a commodity market, prices don't just go up, they explode. We've seen this movie before in other markets. In 2021, nickel prices on the London Metal Exchange went from $25,000 per ton to over $100,000 per ton in a matter of days because a Chinese company had a massive short position and couldn't deliver the physical metal. The exchange had to halt trading and cancel trades. It was chaos. Silver is setting up for a similar dynamic, except the scale is much larger, and the implications are much more significant. Because silver isn't just an industrial metal, it's also a monetary metal with a 5,000-year history as money. When people lose faith in paper currencies, when they see inflation eroding their purchasing power, when they worry about government debt levels and central bank money printing, they buy silver. It's gold's little brother, more affordable, more accessible, but with the same monetary properties. And right now, we're seeing both dynamics play out simultaneously. Industrial demand is hitting record levels, just as investment demand is surging. It's a perfect storm. Let me give you some context on what this means for price. Silver is currently trading around $32 per ounce, having just broken through resistance levels that held for over 40 years. But here's the thing. In inflation-adjusted terms, the 1980 high of $50 would be equivalent to over $180 in today's dollars. Think about that. Silver would need to rise another 500% just to match its previous inflation-adjusted peak. Now, I'm not saying silver is going to $180 tomorrow. Markets don't move in straight lines. There will be pullbacks, consolidations, periods of volatility. But the fundamental setup is so compelling that even conservative analysts are projecting silver could reach $50 to $60 within the next 12 to 18 months. And if we get a real supply squeeze, if the paper market breaks and physical premiums explode, we could see prices that make $50 look cheap. Here's something else to consider. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. Historically, that ratio has averaged closer to 60 to 1. In times of economic stress, it's dropped as low as 30 to 1. If silver just reverts to its historical average ratio while gold stays at current levels, you're looking at silver prices in the $40 to $45 range. If it drops to 50 to 1, which is entirely possible given the supply dynamics, you're looking at $55 to $60 silver, and gold isn't staying at current levels. Gold is making new all-time highs, driven by central bank buying, geopolitical tensions, and concerns about currency debasement. If gold goes to $3,000 or $3,500, which many analysts expect, and silver catches up on the ratio, you're looking at much higher silver prices. Now, let me take a quick pause here because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, you might want to look into how gold IRAs work. I put together a free guide that explains the whole process, how you can get physical precious metals into your retirement account without triggering taxes or penalties. It's in the description below. No pressure, but if this silver story resonates with you and you're thinking about how to protect your retirement savings, it's worth checking out. The guide covers everything: the rules, the custodians, the storage requirements, all of it. All right. Back to what's happening in the market right now, because there's another layer to this story that most people aren't talking about. The geopolitical dimension. We're watching the global monetary system undergo a fundamental transformation. For the past 50 years, since Nixon closed the gold window in 1971, the world has operated on a pure fiat currency system with the US dollar as the reserve currency. But that system is showing cracks. Countries are diversifying away from dollar reserves. The BRICS nations, Brazil, Russia, India, China, South Africa, are exploring alternative payment systems and discussing a commodity-backed currency. Central banks are buying gold at the fastest pace in decades, and silver plays a crucial role in this shift. Because while gold is the monetary metal for central banks and large institutions, silver is the monetary metal for individuals. It's affordable. You can buy an ounce of silver for $32. You can't buy an ounce of gold for $32. If we see a real crisis of confidence in paper currencies, if people start questioning whether their dollars or euros or yen will hold value, they're going to buy silver. It's the people's money. We're already seeing this play out in certain countries. In India, silver imports have surged. In China, retail investors are buying silver bars and coins at record levels. These are populations that understand monetary history, that have lived through currency crises, that don't fully trust their government's paper money. They're voting with their wallets, and they're voting for silver. There's also a generational shift happening. Younger investors, millennials and Gen Z, are discovering precious metals through social media and online communities. The Reddit Silver Squeeze movement in 2021, where retail investors tried to corner the physical silver market, didn't succeed in breaking the COMEX, but it did introduce millions of people to silver as an investment. Many of those people are still buying. They're stacking, accumulating physical metal month after month, taking it out of the market permanently. This is creating a structural bid under silver prices that didn't exist before. It's not just industrial users and traditional investors anymore. It's a global, decentralized movement of individuals who see silver as both an investment and a form of insurance against monetary instability. Now let's talk about what happens next, because understanding the setup is one thing, but understanding the potential outcomes is what allows you to position yourself properly. Scenario 1, the base case. Industrial demand continues to grow, mine supply continues to decline, and inventories continue to fall. Silver grinds higher over the next 12 to 24 months, reaching $45 to $55 per ounce. This is the most likely scenario, and it represents a 40% to 70% gain from current levels. Not bad for a commodity that you can hold in your hand. Scenario 2, the squeeze. Physical delivery demands on the COMEX exceed available registered stocks, forcing the exchange to either source metal from elsewhere at much higher prices or settle contracts in cash at penalty rates. This creates a panic in the paper market, and prices spike to $75 to $100 per ounce in a matter of weeks. This scenario has maybe a 20% to 30% probability, but the payoff is enormous. Scenario 3, the monetary crisis. A major currency event, a sovereign debt crisis, a banking system failure, something that causes a flight to hard assets. In this scenario, silver follows gold higher as people rush to protect their wealth. Prices could reach $100 to $150 per ounce or higher, depending on the severity of the crisis. This is the tail risk scenario, lower probability but catastrophic if it happens. And here's the beautiful thing about silver as an investment. Your downside is limited, but your upside is massive. Silver has industrial demand that provides a floor under prices. Even in a recession, even if investment demand disappears, industrial users still need silver for solar panels and electronics and medical devices. That demand isn't going away. So you have a fundamental support level. But if any of the bullish scenarios play out, if we get a squeeze or a monetary crisis or even just a continuation of the current supply-demand imbalance, your upside is multiples of your initial investment. That's an asymmetric risk-reward profile. Limited downside, unlimited upside. That's the kind of trade professional investors dream about. Let me give you a historical parallel that might help frame this. In 2003, silver was trading around $5 per ounce. Over the next 8 years, it climbed to $50, a 10 times return. What drove that move? A combination of factors. Industrial demand from emerging markets, particularly China. Investment demand as people worried about the housing bubble and financial system instability. And a supply deficit as mine production couldn't keep up with demand. Sound familiar? We're seeing the exact same dynamics today, except they're more pronounced. The supply deficit is larger. Industrial demand is growing faster. Investment demand is more widespread. And we're starting from a higher base, which means the absolute dollar gains could be even more significant. If silver goes from $32 to $160, that's a 5 times return. If you put $10,000 into physical silver today, and it hits $160, you're looking at $50,000. If you put $50,000 in, you're looking at $250,000. These aren't lottery ticket odds. These are based on fundamental supply and demand dynamics and historical precedent. Now, I know what some of you are thinking. This sounds too good to be true. What's the catch? What could go wrong? Fair question. Let's talk about the risks, because every investment has risks, and you need to understand them before you commit capital. Risk number one, a global recession. If the economy tanks, industrial demand for silver could fall, putting downward pressure on prices. However, history shows that during recessions, investment demand for precious metals tends to rise as people seek safe havens. So you might see a temporary dip, followed by a strong recovery. Risk number two, a technological breakthrough that reduces silver usage in industrial applications. For example, if someone invents a solar panel that doesn't require silver, that would reduce demand. But here's the thing. Silver is used in these applications because of its unique properties. It's the most conductive metal, the most reflective metal, the best antimicrobial metal. Finding substitutes that match silver's performance at a lower cost is extremely difficult. And even if a substitute is found, it takes years to scale up production and replace existing infrastructure. Risk number three, a massive new silver discovery or a breakthrough in mining technology that floods the market with supply. Possible, but unlikely. The geology of silver deposits is well understood, and there haven't been any major new discoveries in years. Mining technology improves incrementally, not in leaps and bounds. And even if a major deposit is found, it takes a decade to bring it into production. Risk number four, government intervention. Governments could impose windfall taxes on mining companies, restrict exports, or even confiscate private holdings in an extreme scenario. This is the black swan risk, the one that's hard to quantify but could be devastating. However, silver is a globally traded commodity, and any one country's actions would just shift supply and demand to other markets. It's not like governments can make silver disappear. So, yes, there are risks, but when you weigh them against the potential rewards, when you look at the fundamental setup, when you consider the historical precedents, the risk-reward ratio is heavily skewed in your favor. Here's my take on how to think about this opportunity. Silver isn't a get-rich-quick scheme. It's not a meme stock that's going to double overnight based on social media hype. It's a real asset with real supply and demand fundamentals that are setting up for a major move higher. If you're looking to protect your wealth against inflation and currency debasement, silver is one of the best hedges available. If you're looking for asymmetric upside with limited downside, silver offers that profile. If you're looking to diversify away from overvalued stock and bond markets, silver provides that diversification. And here's the thing that really matters. We're still early. Yes, silver just broke through a 40-year resistance level. Yes, prices are up significantly from their lows. But in the context of where this market is going, in the context of the supply-demand imbalance and the potential for a squeeze, we're still in the early innings. The mainstream financial media isn't talking about this yet. Your financial advisor probably isn't recommending silver. Most retail investors have no idea what's happening in this market. That's when the best opportunities exist, before the crowd figures it out. I've been watching precious metals markets for over 2 decades, and I can tell you, the setup we're seeing in silver right now is as compelling as anything I've witnessed. The fundamentals are there, the technical breakout is confirmed, the momentum is building, all the pieces are in place. The question isn't whether silver is going higher. The question is how much higher and how fast. And the answer to that question will depend on how quickly the supply-demand imbalance becomes apparent to the broader market, how aggressively investors position themselves, and whether we see any catalysts that accelerate the move. What I can tell you with confidence is this. The historic threshold that silver just crossed isn't just a technical level on a chart. It's a signal that something fundamental has changed in this market. The forces that kept silver suppressed for 4 decades are breaking down. The new reality of structural deficits and surging demand is taking over. And if you understand what that means, if you position yourself accordingly, the next 12 to 24 months could be absolutely transformative for your financial situation. This is the kind of opportunity that comes along once in a generation. The kind where looking back 5 years from now, you'll either be glad you acted or regret that you didn't. The threshold has been crossed. The game has changed. Everything is different now. The only question is, what are you going to do about it?